The first thing we'll talk about is risk and return. And to understand these concepts, we're going to mention an important characteristic of an investment, which is you put money down today and get repaid later, hopefully with a premium. In a free market economy, money can flow freely through the economy and be put to use where it's most needed. For example, I could delay the benefit of using my own money now and lend it to an entrepreneur who needs to buy machinery for his factory. On a later date, when this entrepreneur generates enough revenues, he can pay me back and reinvest in his business. There are a couple of ways we can measure the return of an investment. One of them is in terms of profit and loss, which measures the monetary amount we gain or loss from an investment. Here we have the value of our investment or portfolio in period 1, the future, minus the value of this portfolio on period 0, the present time. And this will be good in some situations, but most of the time it's hard to compare between investments since we're talking about absolute dollar terms. Another way to measure return is to think about the proportion of whatever we got back in terms of portfolio value in the future over whatever we invested on period 0. But when most people talk about return, they think about the net simple return, which is our profit and loss in proportion to the value of the portfolio on period 0 or the money invested. For instance, I could say something like, my portfolio had a 20% return over a year. Here I'm talking about the net simple return. These are all measures of return. Now, where is the risk component? To think about that, we need to look at the payoff, which has two important characteristics. One is that it happens over a time period, and the second part is that it's uncertain. And this uncertainty over a time period relates to the risk of this investment. In the next few slides, I'll explain in detail how we can measure this risk. Let's look at an example. Here we have stock S, which at the present time, period 0, has a value of $100. And to simplify our problem, we'll consider only two states of the economy. One up state, where the value of the stock is $125, and one down state, where the value goes to $80. Since we don't know for sure what the value of stock S will be at time 1, we can say that this investment has risk. On the other hand, bond B here has a value of $1 at period 0. And in either up or down state of the economy, the value goes to 1.5. So we know for sure what the value is going to be on period 1. Therefore, we consider this investment risk-free. Let me take the opportunity to introduce the concept of arbitrage, which is key to understanding how financial markets operate. Arbitrage is making money out of nothing. Now, how's that possible? Let's imagine at time 0, I decide to borrow stock S from a friend, and I instantly sell it on the market, making $100 in cash. This concept is known as short selling. I decide to invest that money by buying 100 bonds B. So, what would happen in the up and the down state of the economy? In the up state of the economy, I now have $150 worth of my bonds investment, but I do need to repay my friend back $125. So I basically made a $25 profit here. In the down state of the economy, I also have $150 from the bond investment, and I only have to pay my friend $80. So I made a profit of $70. What's impressive here is that with a $0 investment, we were able to generate a profit. Now, let's see how we could represent the portfolio we created by using a formula. Here we have minus stock S, meaning we short sold stock S, plus 100 times bonds B, meaning we bought 100 bonds B. This is the portfolio we created at time 0. And it was worth $0. It didn't cost us anything to make it. But in both the up and down state of the economy, we made a profit. Arbitrage opportunities are rare in the market, but it's a fundamental concept to assure that assets are fairly priced. Because when investors see overvalued assets, they tend to sell it, therefore bringing the price of the asset down. And when they see undervalued assets, they tend to buy it, therefore bringing the price up. So the supply and demand forces here are key to assuring that assets are fairly priced.